Coming off the heels of a stronger than expected jobs report for the month of February, coupled with all of the geopolitical uncertainties out there right now, we find the stock and the bond markets yo-yoing up and down with no real direction on a daily basis. It looks like the U.S., we've probably discovered our best export right now, which is also, in my opinion, our greatest weapon given what's going on in the world right now. And we're looking at two classic signs of a recession coming, rearing their ugly head after we haven't even talked about this in over 2 years. Crypto looks like it's finding its place in society as of this morning. And the Federal Reserve looks like they might be in this pickle jar right here, because I know when they came into the year, they had big plans for 7 rate hikes. And given what's gone on, they might be stuck. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia, your mortgage broker here at Guaranteed Rate in Beverly Hills, right on Cannon. I hope you're having a great week. So we got the February jobs report last week. 678,000 jobs created, much stronger than expected. We're at a 3.8% unemployment rate, and wage inflation is indeed flat. Now, I've got a couple questions about jobs reports. I always have. I don't think they're as accurate as they could be or should be. I don't think we're taking into account who is participating and who wants to participate and who can't participate. And more importantly, who isn't even allowed to be counted in any of those might want to participate categories. So I know jobs will be created when I go to the grocery store and they're making a checkout line that I don't have to check out myself, and there's actually people there working. I think that's when we'll see this jobs problem over. And on top of that, we had 4.5 million people quit their job in January, and we only created 678,000 in February, so where's everybody going? I guess only time will tell when it comes to jobs. The yo-yo effect the stock market and the bond markets had right now are not good for confidence or sentiment, and as we all know, basically everything is based on confidence and sentiment. Now, what might happen here is, since confidence and sentiment seem to have shifted, prior to, I'm going to say, Thanksgiving of last year, every time you saw a dip in the stock market, people were saying, buy the dip. Now, we could be in a spot where it's sell into the rally. Once again, only time will tell, but I think the next couple weeks are going to be a big test for the stock markets in general, and we're going to see how the bond market reacts as well. And the stock buybacks have actually started on Wall Street. I've seen a few of them this week. Really huge, major companies buying back tens of billions of dollars worth of stock. As we know, as we've discussed, in my opinion, the majority of the support for the stock market over the last decade has indeed been stock buybacks. We'll see if they can keep it up. Now, these geopolitical concerns that we keep discussing, they've definitely changed the landscape of war. Now, war, as we all know it, used to be fought in a more militaristic way with boots on the ground, so to speak. And it looks like right now the United States' greatest export is actually our culture. And when I say that, I mean the way we live, the things we have, and it looks like the rest of the world wants to participate in our culture. And the fact that corporate America has started boycotting Russia at this time, it looks like our most powerful weapon is indeed corporate America. Because I know, and I've seen interviews on TV, the people in Russia, they don't want to make phone calls using potatoes. They want to use iPhones. They want to eat McDonald's. They want to do all the things that everyone else does around the world. And they just don't want to be, a tertiary society. They want to participate. And it looks like the pressure that's being applied right now by corporate America, which is essentially our greatest export, which is our culture, might work and help subsiding this conflict that's going on right now. That, in my opinion, my humble opinion, I thought it was going to end last weekend. They did start a little bit of a ceasefire, but now it looks like all parties are coming back to the table, meeting in neutral countries, looking for a ceasefire. I do expect this conflict, God willing, to end in the next 1 to 2 to 3 weeks. So we'll see what's going on with that, obviously. Only time will tell. Looking at two classic signs of a recession rearing their head. Oil, ugly, ugly, dirty oil, is rearing its head at near 14-year highs up until today. And when the oil prices historically spike the way they have recently, it leads our country into a recession. My best guess, real life stuff, the consumer is tired. Consumer can't go spend more and more of their household budget on gas and transportation and energy. And we are also going to see this head right into our food because our food gets moved around from place to place. So we're definitely going to see this inflation in oil immediately impact our food prices when we go to the grocery store. So when oil moves up like this, typically we head into a recession. And then another theme that I used to talk about all the time in 2019 and the beginning of 2020 is the inverted yield curve between the 2-year Treasury note and the 10-year Treasury note. Right now, the 2-year Treasury is trading at 1.68, 168 basis points. The 10-year Treasury is trading at 1.95, 195 basis points. That is only a 27 basis point spread. Typically, when short-term bonds have a higher yield than long-term bonds, that means there's a lot of uncertainty out there. And when there's uncertainty, they're selling. And when they're selling, typically, there is a recession. So let's see if oil moving up and the 2-year, 10-year inversion, it hasn't happened yet, but it's getting close. Let's see if we indeed head into a recession, as these are classic signs of one to come. And as we discussed last week, crypto still has yet to find its place in our society until this morning when there was an executive order signed regulating crypto. Now, the best I can come up with here, well, not the best, but if you watch The Sopranos, when Tony Soprano went down to Florida to visit Little Carmine, that trip legitimized Little Carmine. Well, when the president signs an executive order legitimizing crypto, that means it's here to stay. Now, the crypto people have been clamoring for this for about 9 years. They finally got it done. Crypto is now finding its place in our society. Step one, we don't know what it's a hedge against. We don't know how it's going to work every day, but at least we know it's here to stay. And the U.S. government has now put their confidence behind it by regulating it, by legitimizing it, much like Tony did for Little Carmine. All right. Taking a look at the Federal Reserve, boy, like Mike Tyson said, everybody's got a plan until they get punched in the face. I feel like the Federal Reserve may have gotten punched in the face recently with all the economic numbers that we're getting, with the geopolitical concerns that are out there. Inflation, we're seeing it every time you leave your house now, literally, because you got to go somewhere, most likely in your car. So we're seeing inflation. It's going to be energy and food first is where we're going to see the inflation. And that's going to be a very interesting setup next week for the Federal Reserve meeting because the Federal Reserve likes inflation when they can control it. Think about it like this. They just dropped trillions of dollars out of a helicopter, so to say. And if we didn't have inflation from that, that means the patient who was on life support at the time is no longer with us. The good news is we have inflation, so the patient is with us. Now, is this justified or rational inflation? Who knows? It's basically the oil traders that are trading up oil futures, which are making the gas prices rise every single morning when we drive by a gas station. So if you take the speculation out of the oil market, we all know the OPEC countries want to drill and ship as many barrels of oil as they can while it has a purpose, because as we've seen them do in the last 20 years, they're shifting their focus away from oil because they know it's a diminishing asset that will eventually be useless. So the people making and selling the oil for us already know it's useless. So it's not going to be an issue to get them to sell us more to take the place of Russia if there is indeed some kind of ban on buying Russian oil. So we're going to see oil be taken up here by the traders and the speculators. Meanwhile, there is no real shortage because the OPEC nations and whoever can drill and ship as much as they want. So this is all speculation here. Every time we drive by the gas pump, the oil traders are making this happen. And by the way, these are the same oil traders that had oil at negative $15 a barrel in the spring of 2020. So as we look at the Federal Reserve next week, there is a lot on their plate. It's going to be very interesting. We're going to talk here about housing for a minute. Housing is solid. Housing is strong. Housing is in demand. And as I always say, the most important part of the housing market is the mortgage paper being clean and saleable, and that's going to keep housing humming along because rates are still not at a place where it's going to hurt demand or where it's going to hurt affordability, which we all know is, at the end of the day, the most important thing out there. All right, well, that's the show for this week. I hope you continue to have a great week. I will be back next week talking about the Federal Reserve and how the markets reacted to their determination. They're probably going to raise rates 0.25%. I'd be very surprised if they went 50 basis points, but we will see indeed if that happens. If you have any questions about your mortgage or real estate